Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Sean O'Hara, president of Pacer ETF Distributors. Sean, it's great to see you as always. Welcome back to Trade Talks.
Thanks so much for having me, Jill.
All right, Sean, we're seeing inflation data contract just a little bit. Would you say we are out of the woods yet?
I wouldn't make that bet quite yet. We are starting to see some numbers, some of the manufacturing reports and some of the spending reports from this morning that were worse than what I think people expected. And I think that's exactly what the Fed is hoping for, so sort of slow down and tamp down the economy a little bit. And if that continues, then I think we could start to see a steady decline in inflation over the next 6 months or so.
Do you think this is priced into the market yet? I mean, have earnings numbers come down enough?
I don't know what the market has priced in, because it sort of surprised me this morning that there was such a big sell-off. The other day we had the big up day on the inflation number being slightly lower. Then we had the Fed yesterday, and they sort of took the wind out of everybody's sails by saying they're going to continue to be, raise rates for longer. And then this morning we had some bad economic data, which would indicate that what they're doing is having the effect that they wanted. And I would have thought that the market would react the opposite and see that as a sign that that maybe the aggressiveness of the Fed would wane a little bit. So the big thing to watch going forward, I think, is as you mentioned, is going to continue to be corporate earnings and revisions and potential revisions to the downside.
Yeah, I think that's what people are looking for, to kind of get to that capitulation point, is to focus on the fundamentals more so than trying to guess what's happening with the macro headlines. But let's review 2022 quickly. What did work this year?
Well, risk management worked for sure. We have a product with the Nasdaq that we're very happy with. It uses a trend following mechanism that's been sort of halfway out of the market all year. And so that's managed some of the downside risk. If you owned energy and healthcare or materials, which we did pretty heavily in one of our larger suite of ETFs, that worked out fine. We have, one of our largest U.S. Equity ETFs is actually up for the year, being driven primarily by being underweight technology and the consumer and overweight energy and materials and healthcare. And we have a global fund that's 100, global equities that's actually up for the year, and it focuses on free cash flow and free cash flow yield. So focusing on high quality stocks to give you a current return in an inflationary environment or one where there's rising interest rates tends to work out better than buying future earnings in growth type investments. So I would say that if you didn't own 2 or 3 sectors, or if you owned the wrong 2 or 3 sectors, that hurt you. And having a risk management strategy in place like we do in our partnership, where we use the Qs on a trend following methodology, worked pretty well.
So with the valuation reset that we've seen in growth and technology names, is it still too early, or do you need to wait, at least till the second half of 2023 to get more visibility?
I think you need to wait a little while. I still think PEs are a little bit high, particularly with inflation where it is. We started the year like 30 times earnings. I think we're somewhere down to maybe 18 times higher for some of the growth names and maybe higher for some of the tech names. And I still think that's a little bit high given the inflation rate that we have and where interest rates are headed. And so there could be some more multiple contraction, not to use it too heavily, kind of a insider. I don't know if the broadcast goes out to the public or is primarily for FAs, but multiple contraction is just that the price you pay for the amount of earnings you get goes down over time. And that always happens when you have rising interest rates and rising inflation. And so I don't think we've seen the end of the potential multiple contraction in the growth and tech sectors yet.
And of course, the million-dollar question is, do you think we will see a recession? I guess the better question is, how severe of a recession do you think we'll see in 2023?
Yeah, I hope not a very severe one. But it's like, it's the same thing that they're dealing with the inflation number. They sort of denied that it was a problem and said that it was transitory, and that was the wrong call. And so things got away from them, and so they have to be fairly aggressive. And now they're trying to do the opposite, which is to try to land an aircraft on the head of a pin, so to speak. And so it's a tough job that they have. And so, I would be in the camp that says that they generally don't get it exactly right. And so I would be leaning towards a little bit more severe recession than perhaps the soft landing that we're all kind of hoping for.
All right, Sean, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.